What is a 401k and why does it seem like everyone talks about it when the topic of retirement comes up? If you've ever started a new job and been handed a packet filled with investment options, contribution limits, and tax terms you've barely heard of, you're not alone. The 401k is one of the most widely used retirement savings tools in America. But surprisingly, many people are contributing to one without truly understanding how it works, why it exists, and how it fits into their financial strategy. So today, we're diving deep, not to sell it, not to slam it, but to give you a clear, complete breakdown of how the 401k works in 2025 and what you need to know to make smarter financial choices. So let's start at the beginning. A 401k is an employer sponsored retirement plan that allows employees to save and invest a portion of their paycheck before taxes are taken out. The money goes into a tax deferred investment account, which means you don't pay taxes on it today, you pay later when you withdraw the funds in retirement. The idea is that your money grows over time through investments like mutual funds, and you'll eventually have a large enough nest egg to live on once you stop working. This all started with a change to the U.S. tax code back in 1978, specifically Section 401k of the Internal Revenue Code. Initially, it wasn't even intended to replace pensions, but over time, it became the primary retirement vehicle for millions of Americans as companies moved away from offering guaranteed pensions and toward defined contribution plans where the employee, not the employer, carries the responsibility for saving and investing. When you participate in a 401k, you decide how much of your paycheck to contribute, and it's deducted automatically, making it easy to pay yourself first. As of 2025, the IRS allows you to contribute up to $23,000 per year if you're under 50, and up to $30,500 if you're 50 or older, thanks to what's called a catch-up contribution. Now here's where things get interesting. Many employers offer what's called an employer match, which means they'll contribute additional funds based on what you put in, commonly 50% of your contributions up to 6% of your salary. That's essentially free money, and it's a big reason why many people participate in 401k plans. But there are rules. Most employer contributions come with something called a vesting schedule. This means you don't own the employer's contributions right away. You typically need to stay with the company for a certain number of years before those matched funds are fully yours. Now, let's talk about the core benefit of 401k tax deferral. When you contribute to a traditional 401k, those dollars come out of your paycheck before taxes are applied. This lowers your taxable income today, which can be helpful for lowering your current tax bill. However, this is not tax avoidance, just tax postponement. You owe ordinary income tax on the money you withdraw during retirement. The idea is that your income will be lower in retirement and therefore you'll pay a lower tax rate. But this depends on your future tax bracket, which no one can predict with certainty. That's where the Roth 401k comes into play. Some employers offer this option and it flips the tax treatment. You contribute after tax dollars, meaning you pay taxes now, but your money grows tax free. And qualified withdrawals in retirement are also tax free. Choosing between a traditional and Roth 401k depends on your current income, your future income expectations, and your view on where tax rates are headed. Both have their place, and some people even split their contributions between the two. Now, let's talk about investments. Inside your 401k, you'll typically find a curated menu of mutual funds, which can include stock funds, bond funds, index funds, and sometimes even target date funds. Target date funds are popular because they automatically adjust their investment mix based on your expected retirement date, starting aggressive and becoming more conservative as you get closer to retirement. While convenient, they're not one size fits all, and it's still important to understand the underlying assets and the fees involved. And that brings us to another crucial topic fees and expenses. Most people don't realize that 401k plans come with layers of costs, administrative fees, and investment management fees. Expense ratios on the funds you choose, all of which can eat into your returns over time. A 1% fee may not sound like much, but over a 30-year period, it can reduce your retirement savings by tens or even hundreds of thousands of dollars. Always review your plan's fee disclosures and look for low cost index funds when possible. Another key rule is access. A 401k is a long-term savings vehicle. If you try to withdraw funds before age 59 and a half, you'll usually pay a 10% early withdrawal penalty, plus income taxes on the amount you take out. There are exceptions, like certain hardships, medical expenses, or a first-time home purchase in some cases. but generally, early access comes with a cost. You also have to start taking required minimum distributions, RMDs, at age 73, whether you need the money or not. These are mandatory withdrawals based on a formula tied to your age and account balance, and they are taxed as regular income. When you change jobs, you usually have four options with your 401k. You can leave it with your old employer, roll it into your new employer's plan, roll it into an IRA or an individual retirement account, or cash it out. Cashing out is almost never recommended unless you absolutely need the money because of the penalties and taxes. Rolling it into an IRA gives you more investment flexibility and often lowers fees, but your decision should depend on your goals and how active you want to be in managing it. Now, let's talk briefly about some pros and cons purely from a natural standpoint. Pros include automatic payroll and deductions, potential employer match or free money, tax advantages, and structured long term investment. It encourages discipline and consistency, which are essential to building wealth over time. On the flip side, cons include limited investment choices, early withdrawal penalties, required distributions, future tax uncertainty, and fees that can chip away at your growth. Also, your money is locked away for decades, so it's not a great option for people looking for liquidity or cash flow flexibility. And while 401ks are market based, meaning they grow when markets do well, they also drop significantly during downturns. So, managing risk and diversification with your fund options is critical. So, you should contribute to a 401k. That depends on your broader financial plan. If your employer offers a match, that's generally seen as a good starting point. But beyond that, it's important to consider things like your tax strategy, retirement goals, how much control you want over your money, and whether you might benefit from other vehicles like IRAs, real estate, or even cash flow focused strategies. The key takeaway is this: a 401k is a tool, not a solution. It can be a helpful part of a diversified financial plan, but only if you understand how it works, how it's taxed, and how it fits into your unique situation. No retirement plan should ever be automatic. Education and intentionality are what separate people who retire comfortably from those who scramble at the last minute. Hopefully, this breakdown helped you feel more confident, more informed, and better equipped to make financial decisions that actually serve your future, not just follow the crowd. If you got value from this video, be sure to like, subscribe, turn on notifications for more clear, practical financial content right here on the Privatized Banking Project. We break down complex topics from retirement accounts to cash flow systems so you can take control of your money and build wealth on your terms. Got a question about 401ks, IRAs, infinite banking, or other strategies? Drop them in the comments. We answer every one.